This preliminary closure of the class.
Don't.
Good afternoon, ladies and gentlemen. Good afternoon, everyone. I believe you can all hear me. Can you hear me? Okay, so I welcome you all to today's training session. Our training for today will be on financial planning and bookkeeping. Financial planning and bookkeeping. It's expected that at the end of this training session, you, the participants, should be able to, 1, understand financial planning activities, 2, differentiate long-term financial plans from short-term financial plans, understand reasons for bookkeeping, identify bookkeeping methods, and we'll show you how to record financial transactions and also how to balance your books, your financial records. So let me start off by telling you this little adage that you cannot run a healthy, successful business without having your books in order. It's not possible for you to run a healthy and successful business if you don't have your financial records in place and if you fail to plan your finances. Any attempt to do that is likened to a man who drives a car without a fuel gauge. And you all know what happens when you drive a car without a fuel gauge. Sooner or later, your fuel will run out and your car will be forced to stop. The car will either be pushed aside to a gas station or it will be towed aside. So the same thing, this same analogy, I want to liken it to you not having a financial record for your business or not having a financial blueprint for your business. What then is financial planning and why do we engage in financial planning? Financial plan is a plan needed for estimating the fund requirement of a business and also determining the sources for the same. What we refer to financial planning is that act of trying to establish how much in terms of naira and kobo that is needed for a business, your proposed business to kickstart. And even when the business kickstarts, how much is needed for the business to operate efficiently and effectively. So first, you identify the fund requirement, and 2, you identify the sources where the funds will be gotten from. So all of these whole activities of trying to estimate how much is needed for that business of yours to kickstart and to operate efficiently, and where the money will be gotten from is what we refer to as financial planning activities. It essentially includes generating a financial blueprint for company's future activities. When we talk of financial planning, we are referring to that act of you generating a blueprint, a financial blueprint, upon which your company will operate for its future activities. So here are the objectives of financial planning. I mean, this is the reason why most companies, most entrepreneurs, most businessmen and women engage in financial planning activities. Number 1 is ensuring availability of funds. Why people engage in financial planning activities is to ensure that funds are readily available for their business. It makes no sense if you have conceived a business idea and it takes forever for the business to be launched simply because funds are unavailable. So the act of planning to ensure that funds are available for the business, for the proposed business to be launched, and for it to turn into a reality is ensuring that funds are readily available. That's what financial planning does. Then secondly, estimating the time and source of funds. You need to estimate the timing and source of the funds. It is not just enough for you to identify that you need X amount of naira for that proposed business of yours. You need to also identify when the that time you need to also identify the source of the funds. I mean, where will the money be gotten from? Should the money be taken from money markets or from capital markets or from any finance institution? So that's another objective of financial planning. Financial planning objective, again, is generating capital structure. For us to plan our finances, we need to generate a capital structure for the business. What do we mean by generating a capital structure? That act of dividing our total fund requirement between what we call equity and debt is what we call capital structure. Take, for instance, you do know that you need 10 million naira to launch your business and to get the business operating. The question is, out of that 10 million, how much will be contributed by you, the shareholders? I mean, you, the owners of the company. So any amount that is brought in by you, the shareholders, is what we refer to as equity. Then the balance that is contributed by third party through debts or borrowing or loans, as the case may be, is what we call debt. So dividing the total capital structure, which we have said in this case is 10 million, between equity, which is what you, the shareholders, have all contributed, and what the balance is to be borrowed, is what we refer to as capital structure, generating a capital structure. Let me give you also an instance. We said 10 million is needed for the business to operate. So if you, the share capital, bring in 4 million, for instance, into the business, that 4 million is what we refer to as equity. Then the balance of 6 million to be borrowed from outsiders is what we refer to as debts or a liability. So capital structure is so important for every financial planning because it helps to put the business on a safeguard in order to ensure that the business owners do not overborrow, because the act of overborrowing will either make the company highly overgeared, meaning that the company relies heavily on debts, on liability, and which in most cases is not good for a business entity, because such business entity will be exposed to several risks such as insolvency and all that, and liquidation problems. So these are the objectives of financial planning. And lastly, another objective of financial planning is avoiding unnecessary funds. The reason why companies engage in financial planning activities is to avoid unnecessary funds from being tied up. No rational investor, businessman or woman, entity or a company will want to hold funds that are not immediately needed. The essence of holding funds is to deploy it as a businessman into the business activity, into the operating activities. So if you are taking up funds as loans, imagine taking up the loans from NISA Microfinance Bank, you should be sure that the funds are taken up or borrowed when they are needed, because every fund that is borrowed has what we call borrowing costs. There are finance charges that every borrowed fund attracts. So in order to minimize or keep this borrowing cost, finance costs to its barest minimum, the interest charge payable, for you to curtail it or bring it to the barest minimum, you need to do a proper timing of your fund requirement to be sure that the funds are taken up or borrowed when they are immediately needed, so that you don't hold up cash that you don't need at that moment and you start to incur interest charges on them. So these are some of the objectives why companies, why entities, why businessmen and women engage in financial planning activities. There are basically two types of financial plans. We have long-term strategic financial plans and short-term operating financial plans. Long-term strategic financial plans is the first type, and the second type is short-term operating financial plans. Let's consider the long-term strategic financial plan. The long-term financial plans consider a number of financial activities, including one, proposed fixed asset investments. Proposed fixed asset investments. Take, for instance, what we refer to fixed assets is those equipment, those items that belong to a company, and the company uses those items for its revenue generation. That's what we refer to as fixed assets. Example of fixed asset for a businessman who is involved in farming will be maybe the tractor, the farm implement that is used, either the whole cutlasses, the tractors, the spraying knapsack machine, or sprayer for spraying herbicides and all liquid fertilizer. So these are some of the fixed assets that an ordinary farmer may have. So if the farmer is considering on how to procure any of these fixed assets, take for instance the tractor, how this tractor is to be financed. So should the tractor be financed by, outright purchase, where the company goes or the owner of the business goes to the market, pays for the tractor, and the tractor is delivered to the business premise? That's one option available to the business, to the company. Another option could be deciding on if the tractor should be financed through what we call a hire purchase, a finance lease arrangement, where the tractor will have to be delivered immediately and the owner will pay gradually through what we call installment. So in an attempt to make this decision or take this decision that best suits the company's operations, such decision is what we refer to as long-term financial plan, because it borders on proposed fixed asset investment. Another activity under the long-term financial plan is the research and development activities. Research and development activities borders on trying to develop a product or prototype for a company before production is commenced at a commercial quantity. So any attempts of a company trying to engage in research and development activities in a manner that will sustain its product in the market space is what we refer to as research and development activities. So these also fall under long-term financial plan. Marketing and product development also is an activity under the long-term financial plans. Capital structure also is an activity under the long-term financial plan. Capital structure, like I explained to us before now, deciding on how the fund requirement will be split between debt and equity. What proportion of the total fund requirement is being contributed by the shareholders themselves, that is the equity, and what proportion or balance is being borrowed or taken as debt. So dividing the total fund requirement between debt and equity is what we refer to as capital structure. So any attempt for a company to take this decision that borders on capital structure, we say that such company is carrying on what we call long-term financial plans. And sources of financing, deciding on where the funding is to be obtained from, borders on long-term financial plan. Sources of financing is also very, very critical for every business, because the sources of financing, every rational investor will want to obtain funds or debt from a source that bears little or no interest. Any source that gives the lowest interest, bear interest or finance cost. So sources of financing or deciding where the funds, the total capital requirement will be gotten from, borders on long-term financial plan. So these are some of the activities that you may have under long-term financial plans, such that anytime a company is considering on capital structure, on how to structure its capital how to invest in fixed asset investment, how to engage in its research and development activity, you do know that these activities border on long-term strategic financial plans. So these plans are generally supported by a series of annual budgets and profit plans. They are supported by series of annual budgets and profit plans. A good way of knowing that a plan is a long-term financial plan is when you look at the time period that the plan is meant to address. If a plan covers a period of 3 years and above, you do know that such plan relates to long-term strategic financial plan. So most long-term financial planning activities cut across 3 years and above. So if a company has drawn up a plan that will address issues of up to 3 years and above, you sure know that such plan is a long-term strategic financial plan. So besides long-term strategic financial plan, the other type of plan that we have is the short-term financial plan. Short-term financial plan. The short-term or operating financial plans specify short-term financial actions. Short-term operating financial plans specify short-term financial actions and the anticipated impact of those actions, and typically they cover a 1 to 2 year operating period. So these short-term financial plans address short-term issues, short-term financial actions, and the period is usually between 1 to 2 year operating period. So a good example of short-term operating plan is management of a company's working capital. What constitutes working capital? A good example of working capital items are if a company is considering on how or draws up a plan on how its inventory, that stock, is to be managed. It means that such plan borders on short-term financial plan. If a company is considering on how to manage its receivable, which is its current assets, receivable, I mean debtors, those people that owe a company, it means that such plan is a short-term financial plan. So for you to know that a plan is of a short time, you basically have to look at the period of the plan, the period that the plan is meant to address, to cover. And we say that a plan that addresses issues between 1 to 2 years is referred to as a short-term financial plan. Cash planning. For us to plan our finances, for us to plan our cash, a major tool used for planning our finances is what we call cash budgets. Cash budget. What then is a cash budget? A cash budget is a statement of a firm's planned inflows and outflows of cash. In other words, a cash budget is any statement that itemizes a firm's total inflows, total revenue, total cash collections arising from its business operations for a particular period, and also its total outflows of cash. Outflow of cash relates to cash purchases and payments. So if a company has a statement that captures all its total sales, as well as all its total purchases in terms of cash, that statement is what we refer to as a cash budget. So a cash budget is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses and shortfalls. The main reason why companies prepare their cash budget is to address what we call liquidity problems. And every cash budget is meant to either show or report a cash surplus or a cash shortfall or deficit, as the case may be. So a surplus cash budget is when all the total cash inflows exceeds the total cash outflows. Meaning if you as a businessman or woman have been able to generate or collect cash more inflows than you have expended through payment, it means that your cash budget will definitely be in what we call surplus. But if, on the other hand, you have been able to spend in terms of expenditure, your purchases are more than what you have received, it means definitely that your cash budget will be in a shortfall. So every rational businessman or woman or company would always want its cash budget to be in a surplus, because a surplus cash budget gives some sort of confidence, some level of confidence to the business owners, to the company, that they have enough resources or cash to pay or settle their short-term debt when they fall due. So the whole essence of cash budget is to showcase whether the cash budget is reporting a surplus or a shortfall. And don't forget, a surplus cash budget is more preferable than a shortfall cash budget or a deficit cash budget. So when you plan your cash budget, emphasis will be on ensuring that your cash budget reports a surplus cash budget. And how do you do that? You ensure that you record surplus cash budget by avoiding unnecessary expenditures. Any expenditure that has not been budgeted during the financial year and will not be of any importance to the business, it is most advisable that you avoid such expenditure in order that you guarantee a healthy cash budget, a surplus cash budget during the financial year. So cash budgets, typically, they are translated into monthly budgets, and from monthly budgets, they are developed into a year period. So here is the typical steps for budgeting cycle. A budgeting cycle, we definitely take these steps, this order. Number one is performance planning. Performance planning. Performance planning is that situation where a company is trying to decide or determine its objectives or goal for a particular period. That's what we refer to as performance planning. So deciding on the objective or goal of that company for a particular period. Let me give you an instance. If you are considering going into farming, and before you go engage in the farming activity, your goal is to make a harvest of, say, 10 tons of maize after the farming activity. So that is referred to as your goal or your objective for that farming season. The 10 tons of maize you intend to achieve after the planting season is what we refer to as your goal, your plans. So this falls under the performance planning, your objective for that farming season. Now, the second step under the budgeting cycle is providing a frame of reference. A frame of reference refers to a benchmark. For every goal that is set, there has to be a benchmark to support it. Because if there is no proper benchmark, you discover that the goal may either, the variations may either greatly be in advanced position. This is what I mean, providing a frame of reference. If we have said that our number one budgeting step is deciding on the objective, which is the 10 tons of maize we want to harvest after the farming period, the frame of reference or benchmark here for us to decide is, on average, for those who have farmed, how much were their returns, I mean, in terms of output, how much output did they harvest per hectare of land? So with that, it gives us some sort of measure, a realistic measure for us to know if our objectives will be attainable or not. So we have to provide a frame of reference, which is basically setting a benchmark that will help us attain the goal or the objective that had been earlier set. And the third one is investigating variations after the implementation of the budget has been done. So implementation, after implementation, we're going to investigating variations. For investigating variations, from the example I gave us, we said we want to harvest 10 tons of maize from after the farming season. So if for any reasons there are variations, maybe we were not able to get the 10 tons of maize after the farming season. Say, take for instance, we were able to harvest 7 tons of maize after the farming season. So we need to investigate variation. The variation here is the shortfall of 3 tons, because we anticipated, our objective was that we should have at least 10 tons of maize, but now we ended up recording 7 tons of maize, meaning that our result in terms of actual is different from what has been budgeted initially. So we have to investigate into the variations. What are the possible reasons why the 7 ton, why the 10 ton, was never possible? So we launch an investigation to ascertain the variance. So the variance here could be adverse or favorable. If it's adverse, it means that it's a shortfall. The shortfall is quite lower than our objective. But if it is favorable, it means that the actual result is greater than the objective we have set, the objective we have set ab initio. So we have to launch investigations into the variations by probing into the possible causes for the adverse results for the 7 tons. So we may probably look into reasons such as was planting done early enough? Could it be that planting was done later? I mean, we didn't plant on time. That's the reason why the 7 ton was attained against the 10 ton that was initially set. Could it be that the wrong farm implement or inputs, such as the crops we used in planting, maybe they were not of high quality and all that? So we investigate into these variations. The fertilizers we use, could it be that they were not of good qualities and all that? So these are some of the investigations into the variations that will have to be launched. And after this step, we'll go into corrective action. Corrective action is putting steps, putting measures in place to ensure that such negative or adverse results is not recorded in the next farming season, for instance. So such corrective actions from the example I've given to you will be putting up measures to ensure that we plant at the right time, especially for that particular kind of crops, and also ensuring that the right farm implements and the right farm inputs are also used during the next planting season. So these are some of the corrective actions that will have to be taken. Then finally, we plan again. Budget is a continuous process. So after every planning, we go through the planning, we compare the actual results from what has been budgeted, and we analyze the variations, and we put corrective measures in place, and we plan again. So budgeting is a continuous process that we'll have to engage on and on. So here is strategic planning and budget. We have 2 types of strategy. We have the long run strategy and the short run strategy. So for every type of strategy that a company wishes to address, it's expected that the company should use the right tool to attain the results. If a company wants to address its long run strategy, it's expected that the company must make use of the long run budget. I mean, the budget must span for a longer period of time. And we said a long run budget spans up to 3 years and above. So for short run strategy, it's expected that the short run budget should be able to address this short run strategy or short run plan. And this short run budget could be for 1 year or 2 years, as the case may be. Cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. The primary function of finance is the movement of money from lenders to borrowers and back again. This is referred to as the cycle of money. So every money that is injected or brought into a business, it tends to rotate. That's what we mean by cycle of money. Take, for instance, if you successfully obtain the loan from the NISA Microfinance Bank, the loan will be injected into your business. Quite all right. But after the loan has been injected, after the fund has been injected into your business, you discover that the funds will find their way out of your business when you begin to make payment of salaries and wages, when you begin to make when you begin to pay vendors and suppliers who have supplied you with one form of goods or services. So you discover that the money that has been paid in, the money that has come into your business eventually finds its way out of the business. Immediately the money goes out of the business, you have produced goods or services, and those goods or services you have produced, you eventually sell them. And when you sell them, customers will pay money into the company, and the money that has gone out returns back again. So this is what we call cycle of money. So you discover that the money that is injected into every business tends to rotate. It goes in and out of the business. Now let's consider bookkeeping activity. Let's consider what we refer to as bookkeeping. Bookkeeping involves the recording on a daily basis of a company's financial transactions. Bookkeeping involves the recording on a daily basis of a company's financial transactions. So with proper bookkeeping, companies are able to track all information of each books, make key operating, investing, and financing decisions. So the whole act of a company or an individual who is into business trying to keep records of all its business and daily financial transactions is what we refer to as bookkeeping. The act of trying to document every $1 that comes in or leaves the business is what we refer to as bookkeeping. So bookkeepers are individuals who manage all financial data for companies. Bookkeepers are individuals who manage all financial data for companies. Without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. So the key check here is that if you have the resources to employ a bookkeeper or an account clerk, it's most advisable that you do so. But if you cannot immediately afford the services of a bookkeeper or an accountant, you can maintain the books yourself. Before the end of this session, I will show you how to maintain bookkeeping in its simple form for your business, even without having a knowledge of accounting. You should be able to at least keep your financial records intact, maintain your bookkeeping. So here are the importance of bookkeeping, the reasons why companies engage in bookkeeping activity. Number one, to ensure reliable measure of a company's performance. One, reliable measure of a company's performance. So for you to know if a company is making profits or not, if a company is bringing in enough returns or not, you have to maintain your books. You have to maintain your financial record. So if you want to know if a company is returning profit or not, year in, year out, you need to prepare or maintain your financial record, because it is a financial record that gives you access into the profitability level of a company. Another importance of bookkeeping is it provides information for strategic decision. It provides information for strategic decisions. So let me give you an instance how bookkeeping provides information for strategic decision. If you are involved in farming and perhaps you have two operating segments, the animal, meaning you have one segment, you cultivate, you rear animal on one hand, and on the other hand, you cultivate crops. These are two operating segments, the animal segment and the crop segment. And after every farming season, you have assessed and you discover that one of the segments, maybe the crop segment, is not bringing enough returns like you want. And you want to close the segment that is not performing optimally. So you definitely have to refer to your bookkeeping to know which of these operating segments is bringing enough returns. 3, bookkeeping provides benchmark for revenue and income goals. Bookkeeping provides benchmark for revenue and income goals. So most times for us to know how much in terms of revenue a company is generating, for us to know how much in terms of revenue a company is generating, you need to prepare your books, your financial records. They have to be in place. So it gives an insight as to how much in terms of revenue, in terms of income that the company is generating, so that the company can vigorously pursue such revenue and income goods. Another one is fulfillment of legal and tax obligations. Fulfillment of legal and tax obligations. You maintain your bookkeeping activity, when you maintain your books, your financial records, you are able to comply with all legal and tax obligations. Let me give you an instance. For the tax issues, most companies that record profit within their first 3 years of operation are exempted from tax payments. So if you're a company and you record losses within your first 3 years of operation, it's expected according to the tax law that you are exempted from tax payment. But in most cases, you will discover that the business owners who are within their first 3 years of operation record losses, and they are still being mandated to pay tax. Reason being that there is no way, no form of record keeping for them to justify that they have recorded losses to the tax authority. So that's why bookkeeping is so important. When you maintain your bookkeeping, you're able to justify and show your financial records to the authority, tax authority, to justify reasons why you should be exempted from tax payments in that particular year. So another importance of bookkeeping is that it provides stewardship to investors. Bookkeeping provides stewardship to investors. In modern day business, you discover that the investors who are the owners of the business, the shareholders, differ from the managers. Managers are those who are entrusted with the day-to-day administration or running of the business. So the only way the managers who are entrusted with the day-to-day administration or running of the business can provide stewardship function is by maintaining their books and returning their accounts to the owners of the business. So in order to prove this, the managers need to maintain their books of accounts and use this as a stewardship function for their reporting to the investors who have invested their funds into the business. And lastly, another importance of bookkeeping is that it's used for proper management of cash flows. Companies that maintain their books of accounts tend to properly manage their cash flows because they can track all expenditures, all inflow of resources, all outflow of payments. So these are some of the importance of bookkeeping. So we have what we call accounting basis. We have what we call accounting basis, and our accounting basis are in two forms. Accounting basis are in two forms. We have the cash basis. We have the cash basis and the accrual basis. We have the cash basis and the accrual basis, accounting basis. Accounting basis simply means the time at which every accounting transaction is to be recorded in the financial statements. The time frame at which every transaction must be recorded in the financial statement. That's what we refer to as accounting basis. So, like I said, we have two bases of accounting. We have the cash basis and the accrual basis. Let's look at them one after the other. The cash basis. Cash basis of accounting records accounting transactions only when cash is actually received or paid. So for cash basis of accounting, the bookkeeper records the transactions only when cash is actually received or paid. So emphasis here is on cash receipt or cash payments. If cash is received, the transaction is recorded. If cash is paid, the transaction is also recorded. But if cash is not paid or received and the transaction has taken place, such transaction is not recorded. Let me give you an instance. Imagine if you sell your item to customers and the customers are promising to make payment to you in 1 month's time. So because the payment has not been made to you, because the payment will be made in 1 month's time, the transaction can only be recorded in 1 month's time when you eventually receive the cash. That's why it's called cash basis. Emphasis is on cash movement. As cash moves, you record the transactions. Let me also give you another instance. Imagine if you buy goods on credit from your vendor or supplier, as the case may be, and you are promising to make payment in 2 weeks' time. So for the fact that you have not made payment, such transaction can only be recorded when you eventually make payment. That's what we refer to as cash basis of accounting. Then the other one is accrual basis of accounting. Under the accrual basis of accounting, transactions are recorded when they occur, even if cash is not received. They are recorded, transactions are recorded when they occur, even if cash is not received. Transactions are recorded when they occur, even if excuse me. Okay, so sorry for that. So we said under the accrual basis of accounting, transactions are recorded when they occur, even if cash is not received or paid. So this has no relationship with cash movement, whether the cash has been received or cash has been paid. Take, for instance, the sales, the example of the sales you made to your customers, which will be paid to you in 1 month's time. Under the accrual basis, such transaction will have to be recorded because for you to have supplied your goods or services to your customers, it means that the transactions have occurred, even if you have not received payment for them. So we look here on the occurrence, emphasis here is on the occurrence of the transactions. And the other instance we made about you purchasing goods from your customers and payment will be made to them in 2 weeks' time. But the fact that the goods have been supplied to you, such transaction is said to have occurred or taken place. And as such transactions will have to be recorded, will have to be booked in your records, not necessarily wait until cash is received or paid. So let me give you an example here. Let me give you an example here. You purchase 100 units of a product and you will pay for it next month. You purchase 100 units of a product and will pay for it next month. So if you are using the cash basis of accounting, because payment is due for next month, no transaction is recorded. Because payment is due for next month, no transaction is immediately recorded. In fact, the transaction will be recorded in that month, in the coming months when payment is eventually made. Or under the accrual basis, because 100 units of products have been supplied to you, he said that the transactions have taken place, the transactions have occurred, and as such, you must go ahead and record the transaction. So, ladies and gentlemen, you must know that the cash basis of accounting differs from the accrual basis of accounting in the sense that cash basis of accounting considers the cash movement in and out of a business before a transaction is recorded, an accounting transaction is recorded. While the accrual basis does not look at the movement of cash, rather it looks at the occurrence of the transaction before the transaction is recorded. And it is very important that we state here that any of the accounting basis that is adopted must be applied consistently, meaning if you adopt the cash basis of accounting, it's expected that you apply it consistently. You cannot use the cash basis of accounting this year and next year you want to use the accrual basis of accounting. It is not permitted. If you decide to use the accrual basis of accounting, it's expected that the accrual basis of accounting must be applied consistently. No switch in accounting basis is permitted. Take note. Methods of bookkeeping. There are basically two methods of bookkeeping. We have the single entry bookkeeping method and the double entry bookkeeping method. Don't forget that I told us that before the end of this training session, I will tell or teach some of us who do not have accounting background on how the books of accounts are to be maintained, on how to maintain bookkeeping, how to maintain the account in a simple form. So for the single entry bookkeeping, you discover that accounting transactions, single entry bookkeeping is straightforward method where only one entry is made for each transaction in the books. Only one entry is made. In this case, let me give you an instance. Some people may say, oh, because I don't have accounting knowledge or background, I just want to record all my expenditures in one book, all my revenue or income in one book. Some people may just buy a hard note cover book, a hardcover notebook, where they will have to record their transactions as they occur. Some people also may go in for what we call cash column analysis book. And as transactions occur, they record them under the right column. You say, okay, the first column relates to salaries and wages. If I pay salaries and wages for this month, I'll record it under this column. The next column is going to be for utility. If I pay for utility, take for instance, water bill, electricity bill, I'll put it under the next column. The third column is going to be for repairs and maintenance. If I pay for repairs and maintenance, I'll put it under this column. So that at the end of the month or the financial year, you should be able to know in aggregate how much has been spent on each of the expenditure line. And you may also have another column that you record all your sales transactions, So these are simple ways of keeping your books, the single entry bookkeeping method. These are the same simple way. Also, some people, I've seen instances where people use their check stubs. The check stubs, immediately they issue checks to their vendors, they fill out the check stubs, the small leaf left on the booklets. They put the narrations and the amount of the transactions to help them in the future if they want to prepare the accounts, so that reference can be made to those check stubs and the account will be produced thereof. So these are single entry bookkeeping methods that you, as even a non-accountant, can deploy and ensure that your bookkeeping activities are kept up to date. The second one is the double entry bookkeeping. The double entry bookkeeping is more robust, very, very robust. It follows the principle that every transaction affects at least two accounts. It follows the principle that every transaction affects at least two accounts, and they are recorded as debit and credit. So this is more suitable for those who have accounting knowledge or accounting background, where every transaction will have to be recorded under a debit and a credit. For example, if you sell a bag of cowpea, that's beans. You sell a bag of cowpea for 20,000. The entries will be debit the bank or cash, depending on if you have received the money. You debit the bank or cash, and you credit the sales account. But not to worry, I understand that some of us do not have accounting background, so I will not dwell so much on debit and credit. There's what we call accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. When we design accounting systems, they are meant to collect, document, and report on financial transactions affecting businesses. So accounting systems can either be manual accounting system or computerized accounting system. What is manual accounting system? Manual accounting system simply means that accounting transactions are being processed by hands. So any attempt by a company or a business owner to process its accounting transactions with the use of hands, we say that such accounting system is a manual one, where you have to use your hands to document or write on your book and all accounting transactions that occur in a particular period. Then the other one is a computerized accounting system. Under the computerized accounting systems, financial information are recorded by entering them into a computer. So when you use a computerized accounting system, you key in accounting transactions into the systems, into the computer, meaning that you are relying on computer for you to maintain your accounts. Some people may use under the computerized accounting system, some people may deploy the Excel for their bookkeeping, which is the spreadsheet. Some other persons may deploy any of the accounting software such as Sage, Peachtree, QuickBooks, and all that. So any attempt to do that, it means that the company uses the computerized accounting system in maintaining its financial records. So we have said that computerized accounting system is most suitable, and in most cases, computerized accounting system tend to be more accurate than the manual accounting systems. But the computerized accounting system are not totally free from error. They are not totally free from error. That is what we call GIGO, garbage in, garbage out. In as much as they are highly reliable and accurate, they can also contain some information that may be inaccurate, and this inaccuracy may be due to man-made error, GIGO, garbage in, garbage out, because if a wrong input is keyed into the system, it may result to a wrong accounting information being generated from the system. That's what we mean by GIGO. Imagine somebody who wants to post accounting transaction, instead of debiting a particular account, he mistakenly credits the account and debits the one that is meant to be credited. So this can cause even the computerized accounting system, which tends to be more accurate, to be inaccurate. So GIGO, meaning that the computerized accounting system still relies in one way or the other on human effort. An effort must be made to ensure that the data, the information keyed into the system is as accurate as possible. Accounting system. There's what we call GAAP, generally accepted accounting principles. Generally accepted accounting principles. All accountants use the same set of rules to prepare financial reports. All accountants use the same set of rules to prepare financial reports. And these rules are set or designed by Financial Reporting Council of Nigeria. They are the one responsible for issuance of these rules. All accountants are expected to abide by the principles of these generally accepted accounting principles. They guide every accountant in preparing their financial statements. Let me give you an instance. Imagine if there is no GAAP, generally accepted accounting principles, for accountants and business owners to abide in while preparing their accounts. I bet you that most business owners, most accountants will want to prepare their account in a manner that is more suitable to them. Take, for instance, a businessman or woman who does not want to pay taxes to the government authority may manipulate the account in such a way that the profits for the year will be so little, resulting thereby to little or no tax liability. A manager whose reward system is based on incentive, based on how much profit is able to generate for the year, may want to create the account such that profitability for that level is so high to guarantee him or her adequate incentive for that particular period. So in order to guide against all of this window dressing and creative accounting, that's the more reason all accountants will have to abide by the provisions of these generally accepted accounting principles. Financial reports. The end product of all our bookkeeping activity is to help us produce our financial reports. The main reason why we maintain books of accounts, why we have said that bookkeeping should be maintained, is for us to produce financial reports thereof after the books have been kept. It's only natural that you hand over those books you have been able to maintain to a qualified accountant or auditor who will generate, who will prepare financial reports thereof. So financial reports are summarized information about the financial status of a business. So accounting is referred to as a language of business because it is so fundamental to the communication of financial information. Accounting is often called the language of business because when we talk of accounting, we are referring to documenting every naira and kobo that leaves or comes into a business. So that's why it's called the language of business. Accounting reports. There are broadly two types of accounting reports. We have the financial account and the management account. Financial account focuses on reporting information to external users. So if you have to prepare accounts, to serve the needs of external users, it means the type of accounts that you have prepared is what we refer to as financial accounts. I will tell us in a short while who external users of accounts are, those who comprise external users of accounts. Then management account, it focuses on reporting information to management, often referred to as accounting for internal users of accounting information. So the account that is prepared for internal consumption for members of the company and management team is what we refer to as management account. So you must know that financial account is prepared to address the needs of external users, while management account is prepared strictly for internal use or for management use. So here are examples of external users. Here are examples of external users. External users are individuals outside the business who have an interest in the business. Government is a good example of external users. Government, a good example of government entities, FRS. FRS will always call for your financial statements. So FRS, being a government agency, is under the external users of financial reports, accounting reports. General public also falls under the external users, the general public. Take for instance, for those companies who have their shares listed on the floor of the Nigerian Stock Exchange, that's the PLCs, they are always mandated by law to make their financial statements public. So the financial statements are generally made available to the public. Civil societies also may have interest in your financial statements, depending on your line of activity. Lenders also are examples of external users of your financial or accounting reports. Lenders, those who are provided you with funding. Example, if you successfully get these loans from NISA Microfinance Bank, NISA Microfinance Bank becomes a lender to you. And as such, NISA Microfinance Bank can call or request for your accounting reports for your financial statements. Internal users. Internal users are individuals inside the business. Examples of internal users are shareholders, owners of the company. These are shareholders. Managers, those who are entrusted with the day-to-day administration of the company. The managers, they are internal users. The employees also are internal users. So these people will, in one way or the other, rely or depend on the financial information being produced. Primary accounting reports. The end product of maintaining our bookkeeping activity is to help us as businessmen and women, as companies, to prepare our accounting reports. And these are examples of the accounting reports that you can generate thereof from your bookkeeping activities. Number one is the balance sheets. Number two, the income statement. And number three, the cash flow statement. Let's look at number one, which is the balance sheet. What is a balance sheet? Balance sheet is a statement that is prepared to show what a company has and what a company owes to third parties. So any statement that is prepared in order to itemize what a company has and what the company owes in terms of indebtedness to outsiders is what we refer to as a balance sheet. What the company has, we refer to it as assets. What belongs to the company is what we refer to as assets. But what the company owes to outsiders, to third parties, is what we refer to as liabilities and equity. So in any given case, it's expected that our balance sheet must always be equal. And for our balance sheet to be equal, total asset must be equal to equities and liability put together. Total asset must be equal to equities and liabilities put together. Take, for instance, if you have a total asset that is worth 10 million in the company, it means all the assets that your company can lay hold of is 10 million. It means out of that 10 million, part of it has been funded through equity, that's shareholders' contribution. And part of it, the balance, has been funded through liability, which is borrowing or debt from any financial institution. So debt plus equity must equal the total value of assets that a company has. The second type of primary accounting report is the income statement. Income statement is a statement that is prepared to show how much a company has in terms of profitability. So for a company to know if they are profitable or not, the company has to prepare income statements. And income statement is prepared basically by aggregating all sales and all expenditures. So it's expected that when the total sales exceeds the total expenditure, the company has made profit. But if on the other hand, the expenses outweigh the sales, it means the company has recorded loss for that period. So I'll show us its format, a sample of both balance sheet and income statement. Cash flow statement. Cash flow statement is a statement that is prepared by a company to show the liquidity position of the company. Cash flow statement is prepared to show the liquidity position of a company. When we prepare cash flow, we're basically aggregating all cash inflows. And it's expected that all total cash outflows should be taken off from the total cash inflow. And emphasis here is ensuring that a company is liquid. And for a company to be liquid, it means the total cash inflow, meaning the total cash a company has generated in any particular financial year, must be greater than its total cash outflow. What the company has received in terms of cash inflow must exceed what the company has paid out in terms of cash outflow for the company to be said to be liquid. So emphasis here is ensuring that a company is liquid enough and the company has enough operating cash and cash equivalents. The essence of maintaining a good liquidity position is to help a company meet up with its short-term debt when they fall due, so that when creditors come knocking for repayment of the amount, you should be able to dip hands into your cash and cash equivalent and settle such liability. That's the whole essence of preparing cash flow statements to manage liquidity of a company. So here is a sample of the balance sheet. Like I told us, liability and equity put together must equal assets. Like we can see, when we add liability and equity, is expected that it should give us the total value of our asset. So imagine if asset is given to be 10 million, it means that liability and equity, two of them put together must be equal to the 10 million as the same value of assets. So here is income statement. Is expected that for income statement, once we have aggregated all the revenue, we deduct all the expenses, it leaves us with either profit or loss. So here is a sample. Here is a typical format or sample of the balance sheet. When you look at the balance sheet format, you discover that we have two sections. We have the section by the left and the section by the right. Section by the left is what we call assets, while those at the right is the liabilities and equities. Let's start by looking at the assets. Assets are categorized into two broad categories: the current assets and the non-current assets. Current assets and non-current assets. What then is current asset? Current assets are those items belonging to a company which is expected to be translated into cash within 12 months after its classification here. So anything we see under current assets, they belong to a company and they are expected to be converted to cash within 12 months from when this account is being prepared. Cash and cash equivalent is under current assets on the left column. But cash and cash equivalent is already in its liquid form, meaning we don't need any form of conversion. Accounts receivable, that's debtors, relates to those who are owing the company, those who the company have probably sold on credit to. Imagine if you have to sell on credit to your customers. That amount they owe you is what we refer to as accounts receivable. So because we expect the amount that is being owed to you, to your company, to be received within the next 12 months, that's why it's categorized under current assets. Inventory, any stock that a company has for resale is what we refer to as inventory. Stocks, as it's fondly called. So most companies hold stocks, and those stocks are expected to be sold and translated into cash within the next 12 months. That's why they are categorized as current assets. Then we have prepaid expenses. Prepaid expenses, when a company pays for goods or services that it is yet to enjoy the benefits. A good example, you see some people making payment for rent, 2 years rent. Imagine if a company makes payment for 2 years rent, and after year 1, you have to prepare your account. The rent for the year 2, because the company has not enjoyed such services, it will be categorized as prepaid expenses. It's an asset. Then investment, any investment of a company that has maturity within 12 months will have to be categorized as current assets. Then after current assets, we have non-current assets. Non-current assets are those assets of companies which reasonably cannot be converted to cash within 12 months, meaning these assets are expected to live over 12 months. A good examples of the non-current assets are property, plant, and equipment, such as lands and building, office equipment, motor vehicle, if you have any for your company, your plant and machineries, because these items are expected to live over 12 months. That's why they are categorized under non-current assets. Another example of non-current asset item that you find in the balance sheet is the intangible assets. Intangible assets are identifiable non-monetary items without physical substance. Simply put, any asset of a company which the company uses to generate revenue that cannot be seen, felt, or touched is what we refer to as intangible assets. A good example of intangible assets, imagine if you have a fishing license that helps you to fish a particular river. Such a license will be treated as intangible asset because you cannot see, feel, or touch the license. But the license helps you with your revenue generation. Then we shift focus to the right section of balance sheets, which constitute the liabilities and equity. Under the liabilities also, liabilities are further categorized into two broad categories, the current liabilities and non-current liabilities. Under the current liabilities, we have account payable. Account payable represents the amount that your company owes your suppliers or vendors, those who have provided you with goods or services, but they are yet to be paid. The amount to be categorized as current liabilities. And because these people are expected to be settled within the next 12 months, that's why they are categorized under current liabilities. Note payables. If you have any indebtedness, any loan that you have obtained that is due for payment within the next 12 months, it will be categorized under current liabilities. Accrued expenses. Your company has enjoyed goods or services and the company is yet to pay for it. Example, you owe salaries, you owe taxes. These are services you have employed, but you are yet to pay for it. They will be classified as accrued expenses under the current liabilities. Deferred revenue, you have perhaps received income, but you have not discharged the goods, or services for which payment has been made to you. So it becomes a liability, indebtedness to you, and it will come under current liabilities. So after current liabilities, we have the non-current liabilities. For the non-current liabilities, this is indebtedness of your company to outsiders, but of which settlement must be made after 12 months. It's expected that settlement must be made after 12 months. The non-current assets. So long-term debt or long-term loan is an example of non-current liability. If you successfully get this loan from NISA Microfinance Bank, it will be categorized in your balance sheet as long-term debt under the non-current assets. And finally, the other section is the equity. Equity is any item or balances belonging to shareholders. Shareholders are owners of the company. The owners of the company, those people who have contributed money for the business to be set up. Example, ordinary share capital belonging to the owners, retained earnings or accumulated profit or losses. So these are some of the balances you may have under your balance sheet. So if you notice, you discover that your balance sheet, the left-hand side and the right-hand side are equal. Then we have income statements. If you look closely, you see the income statements, the sales. We see various items accounting for the sales. We have the client service revenue, the book sales, professional consultation. These are some of them. So it's expected that when you carry out business activities, you should be able to report those line of activities that earn you income. So imagine if you are into farming and you cultivate various crops, it's expected that you list the various crops that have earned you revenue or sales for that period, such as revenue from maize, revenue from beans, revenue from rice, and so on and so forth. So for clarity purpose, they must be segregated from each other on the face of the income statement. Then the expenses are aggregated. If you look closely, you see the expenses, wages, marketing, advertising, rent, utilities, memberships and publications, insurance, consultations, and all that. So it's expected that once the revenue is aggregated, the expenses are also aggregated. The expenses are taken off from the revenue or the sales, as the case may be, leaving us with profit or loss, on which taxes are to be paid. If you also notice, you will see that this income statement has the current year, which is 2004, current year, and it also has the 2003 being referred to as the comparative year. It is very important that when we prepare accounts like this, we present the comparative year, that's figures for last year, so that users of financial information will be able to make adequate informed decision and compare the 2 years. Anybody who looks at this account will want to know if the company recorded growth during the year or there is a decline in the performance. The person may probably consider the profits, if the profit has increased or it has decreased from what it was last year. So that's the more reason why comparative figures will have to be provided. There are components of accounts, basic components of accounts, meaning every account that you prepare, every report that you prepare, financial report that you prepare must have any of these 5 components: assets, liabilities, equity, revenue, and expenses. The first 3 among the 5, the first 3, which is assets, liability, and equity, they are used for the preparation of balance sheets. They are used for the preparation of the balance sheet. But the last 2, which is revenue and expenses, they are used basically for preparing our income statement. So no matter the accounts you want to produce, you want to draw up, you definitely need any of these 5 components. Double entry, I don't want to drag us into double entry because I know some of us may not have an accounting background, which will entail debiting one account balance and crediting the other account balance for every transaction that takes place. But remember, there are ways you can maintain your account even as non-accountant, which we have discussed, which is the single entry methods of bookkeeping. Single entry methods of bookkeeping. You decide on which of the methods that suits you, whether to maintain a hardcover notebook where you keep all these records, you document all your transactions as they occur, or you maintain them in a computerized way by keying them into your Excel. These are simple ways of maintaining your financial records even as non-accountants. So on this note, ladies and gentlemen, I would like to stop, and the floor is now open for questions from you. So if you have questions, you can indicate by a show of hands, or you click on the chat to raise your hands so that we can unmute you and take questions from you. Any question?
Hello.
Any question? Hello.
Hello.
Yes, sir.
This is Adebola Sanjo.
Okay, go ahead, sir. I can hear you loud and clear.
All right. So thank you. Well done for the training. But there is one area I want to talk about. You are talking about planning, budgeting and planning for the business.
Yes.
Like me now, I'm a poultry farmer.
Yes.
What about maybe you have do your planning schedule on the activities for the year, but suddenly things change. That is, the policy of the government changed, and the prices of the what you have budgeted for change. So on that, in that aspect, so what is going to happen?
Okay, Mr. Demola, budgeting activity is quite different from the actual results. Let me put it that way. Yes. In most cases, it's expected that you plan your finances and you budget your finances. Budget is quite different from actual results. And in most cases, it's discovered that the actual results tend to vary from what has been budgeted. And the variance can either be favorable, meaning that you have recorded more than you anticipated to receive, or it can be adverse, meaning that you have not, received up to what you expect to receive. That's the adverse, yes, of it. And due to government policies, like most of us are crying and shouting because of the COVID and everything, which has impacted negatively on most economic business activities, you discover that, I'm not trying to project a doom, but you discover that this year, after the farming season, the results will tend to show adverse results, meaning that the plan will differ greatly from what has been budgeted, either due to price escalation, like you have said. But in any case, there is room for variance. There is room for variance. There will always be room. There will always be variance between your actual results and your budget you have made. Yeah. So it's not left for you after the budgeting activity, when you have taken stocks and you have assessed yourself to see if you did well or not during the year. It's not left for you to re-strategize and plan again against the next coming season. And don't forget, when we're looking at the budgeting cycle, the last on the cycle is planning again. You plan again, meaning that budgeting is a continuous process. No matter what the outcome is for a particular financial year, you go ahead and do what? And plan again. But before you plan again, you have to assess the reasons for the variations. Would it be that you didn't plant early that caused the variation, the variance? Would it be that you didn't use the right farm implements or inputs? Yes. Could it be that you didn't use the right seedlings and all that? So these are some of the reasons why your actual results may tend to differ from your budgeted results. But in any case, it's only budget. It's just to keep you on your toe, to guide you and make sure that unnecessary expenditures are avoided. And your expenses, as you have projected, you pursue them vigorously to ensure that you have a successful outing for that particular period.
Okay, thank you.
Thank you, sir.
All right.
Any other question?
No, from me, no.
Thank you. Any question?
Hello?
Yes.
Yes, hello.
Yes.
Yes, I just want to appreciate your lecture.
Thank
quite
you,
explicit, and we have taken a lot of notes, and I just want to say thank you so much. And we'll still go through the slide, and I just want to say thank you for the notes, and appreciate you. God bless you, sir. Yes, sir. And it will really help, especially the bookkeeping and the rest. It will really help. It will really help. Shows that whatever we do, we should be able to put things on paper, making sure that everything is accounted for. In order so that at the end of the year, it will also help us, like you said, to plan for the next year. To also help us to plan for the next year and also compare what happened this year and next year to help us forge ahead. Thank you so much. I want to appreciate you again.
Thank you, sir, Mr. Franklin. Thank you.
Thank you so much. Yes.
So, any more questions? So, Mr. Franklin, I see two people. I see a hand. So, two of you are taking the lectures. Hope Madam also paid for these classes.
Yes. Yes.
Yes.
Okay, okay.
Yes.
You
All right.
comment on your own.
All right, thank you.
She's on her own.
All right.
She's on her own.
Okay, any more
She's on her own.
observations,
Thank
questions,
you so much.
contributions?
Just that the network was a bit cracky.
Oh, so sorry about that. So we'll send a video recording of the lecture. You can always go through it at your convenience. All you need is just data, as well as the
That's
material.
wonderful. Okay, that's
Yes, as well as the material.
wonderful.
Amber, Olag,
Thank you.
somebody's hand is up. Amber, Olag, please unmute. Okay, Mr. Amber, Olagu, unmute.
Yes,
Okay,
I just
so
spoke with Franklin. Yes, yes, I just spoke with Franklin.
okay, wow.
I just spoke with Franklin, I guess, appreciating the fact that we'll get the video recording.
Okay, we'll do that, ma'am. Thank you very much. Thank you.
Yeah, thank you so much. Yeah.
Okay, so in the absence of any more questions, contributions, or observations, it's expected that you take your quiz, and the quiz is expected to last for just 5 minutes. Just 5 minutes, so that our Muslim brothers and sisters can go for their prayers. The quiz is just for 5 minutes, and it has been posted to the group. The quiz has been posted to the WhatsApp group. So it's expected that you attempt the quiz and submit your answers within the next 5 minutes. So exactly by 1:40, exactly by 1:40, the class will come to an end. By 1:40, the class will come to an end. So quickly make attempt on the quiz and submit your answers. Okay, welcome back. It's already 1:41 by our time, and we expect by now most of you should have turned in your answers to the quiz. Or if you have not finished the quiz, you still have between now and the next 24 hours to submit your answers for the quiz. So on this note, we want to appreciate every one of you for your time and for your participation. We like to bring the class to a close today. So tomorrow, I'm sure we'll be converging online for the certificate issuance tomorrow, which will be communicated via, the timing will be communicated via the WhatsApp group. So once again, we want to appreciate you, and most of us are busy people. Some of us will want to go for prayers today being Friday. So on this note, we want to say that the class has come to an end.